Good. Okay, so good evening and welcome to the stream this evening as we try to, you know, talk over the next papers that we have for tomorrow. That is Management, Accounting, and Advanced Audit and Assurance. Now, these two papers are not related. There is only one thing that they have anything that is in the two, and that is ethics. And because ethics is in management accounting a little bit, that you need to understand, and it's the same thing in financial reporting and other papers. But the ethics in advanced audit, the way it is going to be set is going to be different. So these two papers are not related at all. However, there was no way we could have, different sessions for these subjects separately. So what I'm going to do is to be able to go through them one after the other. There are 5 questions in advanced audit and assurance. So we're going to go through the five. There are 5 questions in management accounting. So we're going to go through the five. So to be able to optimize our time, I'm going to be doing one MA, one audit, one MA, one audit, one MA, one audit. Sorry for that, in that particular case, so that we can optimize our time and not spend a lot of time. But before I get excited, if there are any questions for me, those of you joining us on Zoom, you can raise your hand and bring you up, or you can put it in the chat for me as well. For those of you joining us on socials, that is on Facebook as well as on YouTube, you can still put it in the comments or the chat box for me. I'm going to be replying to all your questions. It should be brief, straight to the point, something specific that you would want me to share my thought on. So, like I said, we're going to do audit, management accounting, audit, management accounting, audit, management accounting. Bear with me because that is the only way we could optimize the time, all right? So that we don't uh, we don't have separate time and all that coming in. So you're going to bear with me, but it's going to be very, very productive. And it's a crucial time because, and I'm going to be doing something very important that is going to be playing out in the exam hall. So you want to stay with me very well to make sure we really wrap up on these things very well as we position ourselves to ultimately pass the exam for the papers that we have tomorrow. So seeing some things coming up. Let's see if I can take this. Yes, Daniel, your hand is up. What you got? Yes, Daniel.
Yeah,
Okay.
yeah. Hello. Good evening.
Yes, good evening.
Hello. Yeah. Uh, I would like to know, can we have more than one threat in a given scenario? Assuming we have something like, let's say, you see, we have the five thread, advocacy threat, self-interest, and that kind of thing. Can we have something like two of the threats in one scenario?
Yeah, that's very possible. For
Oh, okay.
instance, if we have, let's say that we have the auditor and he's auditing the financial statements of the company and he sees something, and then he goes to tell the wife that the wife should uh, you know buy shares in the company because the company, maybe they have a meeting with management talking about going concern issues at the end of the audit, and then management spilled the beans and shared something with the audit team that, oh, we are planning on this product, we are working on this design, and so because of that, that is why we know we can continue as a going concern. And the auditor assesses that, okay, when our audit report comes out plus this announcement, the value of the company shares is going to go up. So he goes home after eating, then he starts spewing out garbage with the wife so that the wife will go and buy some shares in that particular company. What are we seeing there? There is an issue about a self-interest threat there, because the wife will buy the shares, and if the value goes up, he's going to benefit as well. But then also there's a familiarity threat, because the reason why he's sharing that information to the wife is because of the relationship that they have between themselves, and that is a familiarity threat. And these threats will mean that this accountant is acting unprofessional. So that is a breach of professional competence and professional behavior, and that is against the rules of integrity. And even the whole act is illegal because it amounts to quote unquote insider trading. One party having an information that other parties do not have, for which that person leverage on to make an investment decision. So yes, a scenario can present itself with more than one threat that we need to understand. The key thing is to be able to know how to really explain it so that it can be contextualized in the given scenario. So that is the issue about that, Daniel, when it comes to that.
Okay, I'm good.
Okay. All right. Okay, so I see some of you guys joining. You're welcome to the stream. It's an unconventional stream, meaning that we are doing two things that are not related. I mean, management accounting and advanced audit and assurance. So, in order to optimize my time and optimize the session as well, we're going to be doing one. Are you getting it? One management accounting, one auditing. One management accounting, one auditing, so that we can optimize the time and then be able to get the best out of it. Those of you joining us on Facebook as well as on YouTube, you can leave your comments, you can leave your questions in the comments or the chat box. I'm going to be reading all your comments and also reply to you. Those of you joining us on the live call on Zoom, you can raise your hand. I bring you up. You have something specific to ask me, or put it in the comment in the chat also for me. If you don't want to talk or you don't uh, have a good background to talk. So, any questions for me again before you know I get excited? Okay, so let me begin the journey quickly and then walk you through a couple of things that we need to revise on, that we need to know about generally. And then if I take something and then someone has any question in respect of that, you can raise your hand, I bring you up, or you can throw it in the chat for me as well. So let me see if I can pull up my slide on this one. Okay. So when it comes to the management accounting, this is the picture of your examination when it comes to management accounting. We're going to be having performance evaluation coming up. We're going to be having short-term decisions where we're going to be applying marginal costing principles. We're going to be having investment appraisal coming into town. Now, you got to be careful because sometimes the examiner can get excited, get some goosebumps, and there will not be anything about investment appraisal. But all other things being equal, we expect something there. Standard costing and variance analysis, a regular customer in the mix. We cannot overemphasize that. Budgeting, a regular customer in the mix. Then some introductory issues. So management accounting, this is our syllabus, this is our exam. And we'll come back to this in a sec. Advanced audit and assurance students, this is our examination and this is how our exam is going to be. Yes, we're going to be having a question under acceptance of engagement and ethics. We're going to be having a question in respect of audit planning and risk assessment. There is going to be a question on audit procedures and audit evidence. Whether I like it or not, it's waiting for you. We're going to be having a question about the audit report, not audit reporting, not audit reports. Then there will be a question on, non-assurance engagement. We're going to be having some questions coming in from the public sector auditing, and then certainly some introductory issues that examiner is going to be throwing in. So when it comes to advanced audit and assurance also, this is the entire syllabus and what we need to understand. So, like I said, I'm going to be doing one auditing, one management accounting, one auditing, one management accounting, so that we can optimize the time that we have available and get out of this place. So, let me start with the auditing, acceptance of engagement and ethics. There is a minimum of 10 mark question waiting for you in the exam hall in respect of acceptance of engagement and ethics, whether I like it or not, is waiting for you in the exam hall. So it is important you understand that. Now, when it comes to acceptance of engagement, this is divided into two categories. First, now in the acceptance of engagement part, we are talking about audit engagement, which is the audit of financial statements, and then also the non-assurance services like forensic accounting, due diligence, issues in respect of review of prospective financial information, review of financial statements. All of these are non-assurance engagements. So when we talk about acceptance of engagement, that is what we are talking about. But when we talk about acceptance of audit engagement first, that is the way we're going to be starting the discussion. Then we're going to be referring to two key things, and that is the ISA 210, International Standards on Auditing 210, agreeing the terms of an audit engagement. Now, according to ISA 210, there are two things generally that the auditor must look out for before accepting to audit financial statements. Please be mindful of this. Before accepting to audit a financial statement. So, in accordance with ISA 210, two things. The first thing that the auditor must look out for before accepting to audit financial statement is the issue in relation to whether financial statements are prepared in accordance with applicable accounting accounting report or financial reporting framework. Financial statements are prepared in accordance with applicable financial reporting framework. That's the first thing we look out for. Are the financial statement prepared in accordance with applicable financial reporting framework? In other words, is the company using IFRSs in the preparation of their financial statement? That's the first thing. Then the second thing that we look out for is to obtain an agreement with management or agreement of management. We obtain agreement of management that they're going to do, among other things, three things. Number one, they're going to be the ones to prepare the financial statements. Number two, it is their responsibility to design and implement internal controls. And number three, they are not going to be hindering us, and they will provide the auditors with all the relevant data or information that they require to undertake their audit. So when someone approaches us to carry out audit of financial statements in accordance with ISA 210, we would have to look out for the financial statements. Are they prepared in accordance with the financial reporting framework? And then we obtain written representation from management whether they are willing to accept that they are the people who prepare the financial statement or who have prepared the financial statement. Two, it is their responsibility to design internal controls that will prevent, detect, and correct fraud and errors and any material misstatements in the financial statement arising from fraud and error. Then number three, that they will provide the auditor with access to all books, records, data, whatever the heck the auditor needs in order to carry out a quality engagement. That is the first thing we look out for in accepting audit engagement ISA 210. But it doesn't end there, because in accepting the engagement, we have to also refer to the international standards on quality control 1, that is ISQC 1. Now, the ISQC 1 also provides that there are three things that we have to take into consideration before accepting an audit engagement. So, in addition to ISA 210's guidelines, the ISQC 1 also provides guidelines on three things that we need to look out for before we accept any engagement. The first one is the integrity of the client. Okay, the integrity of the client. This is very important because we need to know who the company is, who are the management, who are the shareholders, what industry they are in, what sectors they are in. We need to find out all of those things. All those things are captured under the integrity of the client. Then the second thing we need to look at is our competence as an audit firm. So the competence of the firm. So this is where we're going to be talking about issues in relation to, hey, do we have the qualification? Do we have the human resource? What is the experience we have in respect of this particular industry, this particular sector? Do we have the resources available to be able to carry out a quality audit? Are we even qualified, certified, licensed to undertake such audits? That is competence of the audit firm. And then number three, ethical requirements. Ethical requirements. Now, the ethical requirement is where we're going to be having a dedicated question on ethics, which, Daniel asked a question about a moment ago. So there's a dedicated question on ethics that the examiner is going to be throwing at us. But when it comes to acceptance of audit engagement, these are the two things that we look out for. Now, if it is about a non assurance engagement, a forensic accounting, fraud investigation, review of financial statements, due diligence, review of prospective financial information, then we are going to be looking at the last three issues: the integrity of the client, our competence, ethical requirements, and then the contextualization based on the actual assignment that we are looking at, the nature of the assignment, the reports that they expect us to issue. So that is a thin line, because when we say acceptance of engagement, it can be a question that, oh, we have been nominated to come and audit financial statements, or we have been nominated to undertake a review of financial statements or prospective financial information or the other non-assurance services. So you have to make sure you know the perspective you're coming from and to know what exactly you are supposed to write. Then on the ethical environment, like I mentioned, there's a 10-mark question done deal waiting for you on ethical issues that you need to understand. Yes, like we mentioned at this level, the goal is you need to be able to identify the ethical issues. Then you connect it with the fundamental code of conduct that are being breached by the accountant. You need to talk about the significance of the threat, and then when I say the ethical issues here, I mean the dilemma that the person is facing here, or the threats that a person is facing, then the fundamental code of conduct being breached, then the significance, and then the last one is going to be the ways to mitigate or eliminate those threats. Like I told you, even if the question doesn't ask you to state how that threat can be eliminated or mitigated, you have to still write it down. And so that is the default way that the ethics questions will be. However, there is another form of ethics question that the examiner can throw at you. And during our mock discussion under ethics, I showed you that, because there are certain times that it will not be a regular scenario for you to identify ethical issues, for you to talk about significance, da 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 da. No, it will just be a raw ethical issue. Why is ethics important to the accountancy profession? It's an ethical question that the examiner can throw at you. So although this is the organic way, the examiner can have other alternatives that he wants to go to. But that is the first aspect of our discussion and the first thing that you need to understand. 10 marks on ethics, that is waiting for you. No libi libi, no laba laba on that one. But when it comes to the acceptance of engagement, it's also an area that the examiner may bring you a question on. And you have to be able to understand, for whatever thing that the examiner asks us about factors we consider before accepting the engagement, it is important you know where exactly you are coming from in your write-up. Now, in addition to the concept of acceptance of engagement, it is important we also understand the concept of systems of quality control. And we discussed this as well. So it is important you understand that. Remember, we said you can do that with Harlem, you know, human resource, acceptance of engagement, leadership, ethical requirement, and then monitoring. Okay, ethical requirement and monitoring. So Harlem, it's going to be important for you to understand the quality control issues when it comes to that one as well. So that is the first aspect of the advanced audit and assurance. Ethics, 10 marks waiting for us. Acceptance of engagement, it could also be another 10-mark question that the examiner could throw at you, depending. I'm using the word acceptance of engagement because there are two types of engagement. Either it is an audit engagement or a non-assurance engagement. So there could be another 10-mark question that the examiner can bring in that space, and you must know the way you write out your answers. Then also, ethics is going to be there waiting for you, 10 marks. That there is no long talk about it. It's not negotiable. It's a direct thing that the examiner is going to be talking to you about. So that is the issue that you must understand when we talk about acceptance of engagement and ethics. Any question in this area, advanced audit and assurance students, you can raise your hand. I bring you up, or you put it in the chat for me. If you have any questions in respect of this area, then you can bring it up. If not, then I will continue with my discussion in that case. Let's see. Since what do I have here? Please, your volume is low. I don't know. How the heck is my volume is low? My volume is not low. Maybe check your device, because I guess my volume is. Welcome to the stream this evening as we try to, This is loud. I don't know. Maybe check your device. Maybe your device is, too low there on the volume side. Okay. It means I'm good. Right. Then we go to management accounting, students. Now, for management accounting, we have stated that to be able to excel in the management accounting, there are key issues that you have to understand. So, the first thing is the fundamental principles that you must understand when it comes to management accounting. And so, we've said that number one, you need to understand the absorption costing principle. The absorption costing principle. What does it say? Inventory is valued at full factory cost. It says that we are going to be dealing with over and under absorption of overheads. Now, it is important you know how to deal with over and under absorption of overheads. If the absorbed overheads is greater than the actual overhead cost, we say that overhead has been over absorbed. If the absorbed overhead is less than the actual overhead cost, we say that the overhead is under absorbed. When the overhead is over absorbed and we are in the profit statement, you add it back to the gross profit. But if we are in the cost sheet, you subtract it from the total cost. If overhead is under absorbed and we are in the profit statement, you subtract it from the gross profit. And if you're in the cost sheet, you add it back to the cost. So when it comes to the absorption costing, it is important we understand the concept of over and under absorption of overheads. Now, this principle cut across the entire syllabus, so it is important you get the idea well. Then you come to the brother, and that is the marginal costing principle. Everything in the short-term decision will rise and fall on the marginal costing principle. And there are a couple of things that we mentioned when it comes to the marginal costing principle. Number one, we stated that under the marginal costing principle, variable cost per unit remains the same irrespective of what? The output level. Okay? Variable cost per unit remains the same at all level. It's an assumption. It doesn't change. Number two, contribution, it's selling price minus variable cost. No, remember, the variable cost is both production variable cost and non-production variable cost. But contribution, it's something that we must know about it. It's very important generally. So variable cost per unit remains the same irrespective of the output level. And then contribution is equal to selling price minus variable cost. Then the issue then is that total cost is going to be divided into fixed and then variable. And what we mentioned is that in making all short-term decisions, we don't consider general overhead. So in the making of short-term decisions using the marginal costing principle, general or absorbed overheads are not going to be considered in the making of any of the short-term decisions. That is an assumption that we have to follow, that we have to know about generally when it comes to the marginal costing principle. Then the third thing is going to be the brother, that is the activity-based costing. That is ABC. In the activity-based costing, now we are using the cost pool, the major activities that the entity undertakes, okay, which is the cost pool, and the activities that causes the cost, which is the cost drivers. Okay, the challenge you're going to have in activity-based costing is identifying the cost pool and its equivalent cost drivers. But there are general things that are available. If you are dealing with ordering cost, then certainly the number of orders. If you are dealing with production cost or production overheads, then certainly we are going to be dealing with number of production runs or number of setups. If you are dealing with issues about material purchases or material requisition, then we could also use the number of setups. So it is important you remember and go through to identify the cost pool and the cost driver. But remember, if you're in the activity based costing environment, step one, you need to calculate overhead absorption rate for each of the cost pool. Then you come and allocate the overhead using the cost pool calculated, multiplied by the actual activities that occurred. And then number three, you now determine the cost or the overhead per unit so that that will go and be added to the cost sheets that you are preparing. So these three principles are going to be setting the tone, and it runs through the syllabus. We will be applying these principles under variance analysis, under investment appraisal, under issues in relation to budgeting, under transfer pricing in question one. So these fundamental principles, you need to understand them. The third fundamental principle that you need to, or fourth, will be the concept of high and low. Anytime the examiner gives us data about total cost without the individual cost items. So all you have is total cost and probably the activity level. But you need to find out about what a variable cost is, what a fixed cost is. How the heck do you do that? You use the high and low method. And the high and low method says that the variable cost per unit, it's going to be the maximum total cost minus the minimum total cost divided by the maximum output minus the minimum output. Then once you get a variable cost per unit, you can use either maximum output or minimum output to get your total fixed cost. Then you can contextualize and answer the question. So that is also another principle that you need to understand when it comes to dealing with these issues. So fundamentally, you need to understand these principles very well because they're going to be running through the syllabus. Now, so based on the marginal costing principle, you then come to one major aspect of the syllabus, which you're going to get a 15-mark question on, and that is short-term decisions. And there are a lot of the short-term decisions here. We've spoken about them. Relevant cost analysis, make or buy, limiting factor analysis, shut down, and all of those short-term decisions, break even analysis. All these are short-term decisions. The key thing here is to understand the decision rule that governs all of them. I will not be able to go through them, but it is important you understand the principles that underlie each of these topics. But we are going to be primarily referring to the marginal costing principles when we are in the short-term decisions. One of them will be in the exam hall for you to answer for 15 marks. Either make or buy, either limiting factor analysis, either break-even analysis. When it comes to break-even, the formulas are going to be crucial, plus the various assumptions that you are going to be applying in solving the questions. But the other short-term decisions, you must know the way you go with the flow and understand the principles when it comes to that. So management accounting, these are the fundamental principles we need to understand. And based on the marginal costing, 15-mark area waiting for us on the short-term decisions. So when it comes to relevant cost analysis, I mean, it was there last semester, but the examiner doesn't have any, permission from you to decide what he will bring or he will not bring. So the fact that it was examined last semester does not mean it wouldn't be examined again because it has been examined in other previous dates before last semester. So relevant costing, I mean, break-even analysis, limiting factor analysis, the make or buy decision, the shutdown decision, a lot of them. By now, I mean, you should be a master of all of them, and that is the way you're going to be excelling. But 15 marks waiting for us there, we need to understand that. Let me also say that if the examiner is generous, then he's going to bring you a 10 to 15 mark question on the preparation of the cost sheets. That is a job cost card, okay, or a profit statement. If he is generous with you, management accounting, then he's going to do that with you. What does that mean? It means that he may ask you to prepare a job cost card or a cost sheet, and you can't be using the absorption costing or the activity based costing. That is a 10 to 15 mark question the examiner can throw at you. Again, if he gets a lot of goosebumps, then he will ask you to prepare the profit statement. In the preparation of the profit statement, that one, it is either you're going to use the absorption costing or the marginal costing. So when it comes to the management accounting, the first part of my discussion, that is what you need to understand. The fundamental principles and how the examiner will apply them in the exam hall. Done deal, 15 marks waiting for us on one of these short-term decisions. But like I said, if the examiner is excited and he wants to be happy with you, a job cost card will be asked for you to prepare between 10 to 15 marks using the activity-based costing or the absorption costing. Or the examiner will go to the OG and then ask you to prepare the profit statement using the absorption costing and the marginal costing. Whatever be the case, these are fundamental principles. So whether they come directly as a question on their own or not, you're still going to be applying the marginal costing principle and the absorption costing principle in the entire syllabus. So that is the first thing you must understand when it comes to management accounting and what you should expect tomorrow when it comes to these issues. Any questions, you raise your hand, I bring you up, or you put it in the chat for me. Management accounting in respect of this particular question here. You can raise your hand, I bring you up, or you put it in the chat for me if you have something specific in respect of these. Okay, let me continue then. Back to advanced audit and assurance. The second area that the examiner may give us a 10-mark question in advanced audit and assurance is the audit planning and risk assessment. It's a huge area. Now, whether I like it or not, there is something about it going to be in the exam hall. Whether it's a dedicated question or you're going to be applying the principle in audit procedures and audit evidence. So, I mean, there is no shortcut here. But audit planning and risk assessment. Generally, we mentioned that there are a couple of few issues. I mean, the audit approach that we discussed, the elements of the audit approach, talking about the scope of the audit, talking about the direction of the audit that is under ISA 315, assessing the risks of material misstatement by understanding the client entity. And in accordance with ISA 315, there are 5 things that you must understand about the client entity. I mean, their internal controls, the external factors, the accounting systems, the structure of the organization, and how management performance is measured. That is a question the examiner can ask you for 10 marks in the exam hall about what you have to understand about a client entity before accepting an engagement to audit their financial statement in accordance with ISA 315. And that determines the direction of the audit. But in addition to that, it's going to be the issue about risk assessment. This is very important because we have the preliminary risk assessment or preliminary risk level and then the performance risks. But it's not really about preliminary and performance risks, it's just about understanding the benchmarks. So please, before you get into the exam hall tomorrow, go through the benchmarks. Sometimes the examiner is not going to be excited to give you the benchmarks in the exam hall, but you need to know about the benchmarks so that it can help you, in dealing with audit procedures and audit reporting, which is going to be a done deal area for you in the exam hall. But risk assessment is going to be something that you need to understand. Now, just in line with that, there are 2 more things that you need to understand, and that is business risk. So you could have a 10-mark question on business risk where the examiner pulls out a scenario and asks you to identify the business risks. Now, when you're talking about the business risks, you are focusing on the company. You are explaining the company what it is that they are doing that could affect either their going concern, could affect their financial statements, could affect their finances, could affect the governance of the company. So business risks really has no formula. But generally, if you remember, we categorize the business risks into four major groups. We spoke about strategic risks, which talks about a certain policy, actions, or decisions that a company makes, which doesn't result into the goals or the profits that the entity wanted to achieve for the period under review. Now, the entity not even making or taking any decision when there is a change in the marketplace is also a strategic risk that we need to understand. Then financial risk, issues in respect of the gearing level of the company and whether the company can be able to meet and repay its debt and be able to get additional funding. Then compliance risks, how the entity is complying with their own internal controls, level 1, laws and regulations that governs the operations, level 2, and directive from other regulatory authorities. If it is a manufacturing company, Food and Drug Authority, Ghana Standard Authority, or whatever the heck, compliance risks is going to be there. Then operational risks, that is what relates to the day-to-day running of the organization. In the exam hall, if you are able to categorize them, whether it is a business, financial risks, compliance risks, operational risks, that's okay. But you are not really under obligation to put them in that category. Once you identify a scenario or you identify something as a business risk, just state whatever it is. Now, it depends on the context of the question. Sometimes the examiner will say, identify the business risks and the actions that the auditor must take. You got to be careful. Identify the business risks and the action that the auditor must take. It simply means what you see that is wrong with the company that could affect their going concern, that could affect their finances, that could affect the governance of the company, that could affect the operations of the company. What should be the auditor's response? Anytime the examiner asks you something about the auditor's response, he is just asking you about the procedure you will undertake in respect of that particular subject matter. That is the auditor's response. What will the auditor do with that particular information that they have come across? So that is the idea about business risks. We're just going to be finding out the scenario given to us, what is going on with a company, and how is what is going on can affect their financials, their governance, their going concern, their operations, or any other issues that relates to the company. So primarily our business risks, boom, will be focusing on that particular angle. But on the flip side, we could have the final thing, and that is the audit risk, which is the risk that the auditor may issue an inappropriate auditor's report at the end of the audit. And if you remember, audit risk is made up is having three components. That is the inherent risk, control risk, and detection risk. If you remember, we said that these first two are outside the control of the auditor because inherent and control risks create the risk of material misstatement. So in order for the auditor to reduce the audit risk to an acceptably low level, the auditor must reduce the detection risk. Now, so in the exam hall, again, it depends on how excited the examiner is and what he wants you to do in the exam hall. He can ask you about the audit risks. Now, if the examiner asks you about audit risks, then you're going to be writing from the perspective of the auditor. What you see in the scenario, sorry, what you see in the scenario, how the auditor sees that, and what will be the implication of that on the financial statement. So primarily, the audit risks, our focus is what is going on in the company, how does it affect the financial statement of the company primarily. So we are going to be writing from the perspective of the auditor and what the auditor is going to be doing at the end of the day. And if you remember, we spoke about the causes of you know the detection risks. We spoke about the issue about sampling and non-sampling risk, and we said if the auditor must reduce the detection risks to an acceptably low level, then the auditor must ensure at the end of the day that they carry out a quality audit. They use computer-assisted audit techniques. They are able to increase the sample size. They are able to use the appropriate audit procedures or audit approach for the work that they are carrying out, and most importantly they ensure that they carry out a quality audit so that they can gather sufficient and appropriate audit evidence. So that is the issue about audit planning and risk assessment. Depending on how excited the examiner is, we could have a dedicated question coming in from any of these guys here for a for a 10 marks question in the exam hall. But even if we don't have any question directly coming in from here, the knowledge here will be needed for us to answer the audit procedure and audit evidence question, which is a 20 mark area coming in the exam hall, whether I like it or not. So that is the second issue that you need to understand when it comes to advanced audit and assurance, and what you are going to be seeing around in the exam hall when it comes to what the examiner will ask you and how you are going to be approaching it in the exam hall. Any questions about this, you raise your hand, I'll bring you up, or you throw it in the chat for me. What do I have here? Okay, just seeing some chat. Let's see if I can bring it up. Give me a sec here. Seeing if I can have my comments screen. So then, hi, say hello, Thon Man. Okay, what do I have? Again. Good evening, sir. Okay, I think I've already addressed this. Then Ozzy Home said, hi, sir. Ready to learn. Okay. Let's see, do I have, okay. So I think I don't have any other questions coming up here. Okay. It means that we're good here. Then let's go to management accounting performance evaluation. This is question 1 in the exam hall, whether I like it or not. It's waiting for you. 20 marks in the exam hall, performance evaluation. That's question 1. Done deal. But it depends on how excited the examiner is. There are 4 things. He's going to bring only one of them. Which one? I don't know. But he has brought all of them in the last 8 examination dates. So you got to know them. And we've discussed them. So organizational performance evaluation. So this is where we're going to be using either financial performance indicators, okay? Financial performance indicators, that is ratios purely to analyze the performance of the organization. So profitability ratios, liquidity ratios, gearing ratios, efficiency ratios. That's one way that the examiner can go. And we dealt with that. So it's one way, it's a whole organizational performance measurement. On the second level, the examiner would want to, mess it up a little bit. So he will have you for both non-financial and financial performance indicators. So this is where the examiner may call on you to use the Kaplan and Norton's balance scorecard. So if you're using the balance scorecard, then it means you're going to be using both financial and non-financial performance indicators. Financial perspective, how profitable is the company? Customer perspective, how are we able to satisfy the customers? Internal business perspective, the efficiency and effectiveness of the organization, and then learning and innovation, what the entity is doing to improve upon its current performance. So balance scorecard, it could be there, or the other one, Fitzgerald and Moon building block, dimensions, standards, and rewards. Dimensions, standards, and rewards. So, depending on how excited the examiner is on the whole organizational performance measurement, that is the first thing that we need to understand and remind ourselves on. Now, for those of you who are doing financial reporting, definitely you remember your ratios, and we did this also in class. So, remember your ratios, how to do the calculation, how to do the interpretation, because that is very important. And make sure you go through the balance scorecard because it's an area that the examiner could throw at you. The concept of divisionalization, how do we measure the performance of a responsibility center, meaning a center with a designated individual heading that particular center? So remember, we said we can use ROI or RI, that is return on investment and residual income. What we mentioned was that the return on investment is going to be your controllable profit, all right, divided by, the investment. Sometimes the examiner can tell you to use average investment or the net investment. Whatever the examiner says, please obey that, times 100, and then we do our workings. If we are in RI, that is residual income, that is how much money will be left to the company, to the division, after they have paid providers of finance. And we said this is going to be controllable profit minus notional interest. Okay, controllable profit minus notional interest. The notional interest is simply going to be your, net asset or average investment, whatever the heck, multiplied by the cost of capital of the company. It'll be given to you in the question. You don't need a miracle for that. But a key thing here is the concept of controllable profit. What is controllable profit? The controllable profit is the profit of the division that they have control over. In other words, when we are giving the profit of the division, and that includes overheads incurred by the head office, which has been allocated among the divisions, then we have to take out those overhead costs, because it is not the division, or it wasn't the division that incurred those costs. So it will be unfair to apportion those costs to them and use that to assess their performance. So controllable profit means the true profit of the division, excluding any allocated overhead from the incurred by the head office. So the goal here is controllable profit, and you want to be mindful of that. Now, between these two, we mentioned that the return on investment is the appropriate. Why? Because the residual income formula discourages divisions from making capital investments. Because, uh, if they don't make a lot of investments, then their residual income is going to be high. But really, the ROSI brings out the true picture. So, in order to ensure that the divisions are not sabotaging themselves, which means it will not sabotage the whole company so we can achieve goal congruence, it is important that the entity shifts from using residual income to the return on investment, as the return on investment will encourage capital investment, will encourage expansion, will encourage innovation, and will improve productivity, which is good for the divisions individually, but also good for the company as a whole. So that is the concept of divisional performance evaluation. That is the second thing that examiner could get excited about and ask you a question of from. Then the third thing is going to be the concept of transfer pricing, where we are asking a division within the company is selling to another division within the company. What price should the selling division sells its product to the buying division within the same entity? That is the transfer pricing. And we mentioned that in making that decision, it is either that the entity is having, or the division is having, limited, you know, resources with unlimited demand, with unlimited demand, with unlimited external demand, or they have unlimited resources with limited external demand. These are the two things. Now, depending on whatever the heck we are at, the goal is to find out what is the minimum transfer price they can charge. So if they have unlimited capacity, but they have limited external supply, then the minimum transfer price they can charge will be the marginal cost of production. That's the minimum transfer price, the marginal cost of production, the marginal cost that they incur in producing the product, meaning they have unlimited capacity anyways, but they have a limited external supply. But if they have a limited capacity but unlimited external supply, then the minimum transfer price will be two things. That is the marginal cost of production, the marginal cost of production plus any lost contribution, which is going to be the opportunity cost of selling the product internally instead of selling it to an outsider. So it depends on where we are coming from. That is the minimum transfer price that they can charge them. However, we also said that our goal is to look out for what we call the optimum transfer price or the optimal transfer price, depending on whatever the heck you are coming from. But optimum transfer price. The optimum transfer price is simply the price at which the selling entity sells at a profit, the buying entity or the buying division buys at a least cost, and the organization as a whole makes a profit. That is what is referred to as the optimum transfer price. So it is important we understand that. But we boil down to say that, hey, listen, the fact that one division must sell to the other division doesn't mean it is like that all the time. Because if the minimum price that the division selling will charge is, say, $10, but then the buying division can buy it externally from outsiders at a price of, say, $8, and the selling division also has unlimited external supply or external demand, then there is no need to transfer because we want to achieve goal congruence. So in that case, there will not be any transfer of goods between the two. Why? Because we will let the division who is producing to sell all to the outsiders so we can make more money, and then the division who needs the other division's output as their input should go outside and buy it at what? $8. That's not a big deal. So although yes, we are looking for transfer price, it is not all the time will there be goods transfer, because we want to achieve goal congruence, which is one of the core principles of transfer pricing. And it is important you understand the principles of transfer pricing as well, because it's a question that the examiner can ask you. So that is the third thing that you need to understand: transfer pricing. Then certainly the fourth thing is going to be assessing the performance for not-for-profit making organization, and we're going to be using the value for money concept, whatever, economy, efficiency, and then effectiveness, usually to assess the performance for not-for-profit making organization. All these, question one, either one of them at least or two of them the examiner want to bring up. But usually what we've seen the examiner doing is just one of them, and sometimes 20 or 15. Then the other 5 mark question will be an introductory theory issue, either total quality management, benchmarking, or whatever the heck. All right. But that is question one. And these are the things that we have to be on the lookout for and the things that we have to look at. So that's the idea about that. Question one, performance evaluation, 15 marks minimum. If the examiner is excited, gets a lot of goosebumps while setting the question, then you're going to get it for 20 marks. And it means you're going to do a lot, and it could be a whole organizational performance, it could be a transfer pricing, or it could be the concept of divisionalization or whatever the heck the examiner wants to bring you. So that's the idea about that, and that is question one. So any question about this, management accounting students, you can raise your hand, bring you up, or you put it in the chat for me. Let's see if I have some questions here. A sec. Any about that when you get to the exam or you ask the examiner, he's going to be telling you about the subject matter that he wants to ask you about. But, 4 issues minimum, 5 maximum, each of them taking 5 marks, and the examiner is going to be excited to ask you about that. Then you come to the concept of audit evidence. This is the primary issue. The auditor must obtain sufficient and appropriate audit evidence. What does appropriateness means? It means the evidence obtained must be reliable. Okay? How do we know the evidence is reliable? Evidence obtained by the auditor is more reliable than evidence provided. An original copy document is more reliable than a photocopy. All right. Evidence provided by an expert is more reliable than evidence provided by management. An independent expert is more reliable than the evidence provided by management. All of these things we must understand. Then the last thing is, as part of the audit procedures, we may use the work of experts. And so, if there is a subject matter in the question that will require the use of an expert's work, maybe a valuer, maybe an actuary for pension purposes, IAS 38, or maybe a real estate agent for a revaluation of the assets of the company, or any other things, another audit firm who undertake the tax returns of the company, and we are going to be using their work on audit, then it is important that we look at the factors to consider before using the work of an expert. And you know these things already: the person's qualification, the person's independence, the person's membership to any professional organization or body, and all of those things. So that is the idea about audit procedures, audit evidence, done deal, waiting for you in the exam hall. So know the subject matter. What the heck is this? Okay, is there an accounting standard for this? All right. Is there a figure in here? Can I calculate some materiality? That will be the first thing you write as part of your audit procedures. That will come first, the materiality threshold. Then, what accession am I testing for? Is it an account balance at the reporting date? Is it a transaction or an event? Or is it about disclosure requirement? Once you know the accessions, then you can write out your audit procedures. Keep it sweet, simple, straight to the point. State the accession, write out the audit procedures, and bam, 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 you are, going to give the reason for that. So, for instance, if you're auditing non-current assets, or the company undertakes a project and you're supposed to audit that project because they have capitalized the cost of that project in their financial statement in accordance with IAS, whatever that they are applying, 20 IAS 16, IAS 40, or whatever accounting standard they are applying, and the project is still ongoing. You're undertaking procedure, then you say physical examination or site visitation. Now, what is physical examination? What is site visitation? So you have to be specific and write a clear audit procedure. That is the idea about the 20-mark area waiting for you in the exam hall when it comes to this part. Any questions about this? Advanced audit and assurance. If there are any questions, you raise your hand, I'll bring you up, or you put it in the chat for me. What device are people actually using that they are saying that my sound is, you know, low? I'm wondering why you're saying my sound is low. I don't know why that. Give me a sec, let me see again. YouTube has been, oh, you're updating my application right now. Okay, give me a sec, let me see. Management, an independent expert is more reliable than the evidence provided by management. All of these things we must understand. I mean, this sound is out. What devices are people using that you can't hear my sound? We are seeing who. Eba asem ni. Oh, okay. I think that thing is coming from Facebook, probably. So I don't know. Maybe it's just an encoding issue with Facebook. Because on YouTube my sound is up in this case. Okay, so that's audit procedure, done deal, waiting for us in the exam hall. Okay, no question. Let's go to man accounting then. Management accounting, investment appraisal. Okay, investment appraisal. Like I said, you may go to the exam and there's nothing about investment appraisal. Please don't take it personal. It's not that the examiner doesn't like you. It's just that he may not be excited about it. That's all. But it's something you need to understand. Now, when it comes to investment appraisal, a couple of things I want you to take into consideration, because this is where we get to the a little bit slippery area when it comes to the management accounting. So there are some theories here that you need to be mindful of, like for instance the issue about how do we call it, the capital asset budgeting or the capital budgeting process. Okay, identification of proposals. I mean, so the entity must have a system in place where they can identify proposal, they can bring a lot of ideas in place where projects can be undertaken. Then number two, they have to, look at the screening of those ideas. Number three, they evaluate the ideas using the various methods of evaluation. And certainly number four, they can now accept a project, implement the project, and continue to monitor the project. It's a theory question the examiner can ask you. Then the theories about the methods of evaluation. Each of them, something, there are theories about them, merits and demerits, advantages of one of the methods over the other method. It's important you understand this very well because the examiner can ask you. So as part of your theory reading, you have to make sure you read these, because you may go to the exam hall and all you see is theory in and the investment appraisal. Theory in for 10 marks or for 15 marks. So be mindful of the advantages and disadvantages of the methods, the merit of one method over the other. Make sure you go through that very well. And then the capital budgeting process. It's a 10-mark question the examiner can throw at you. You want to make sure that you understand that very well generally in the exam hall. Then the second thing is going to be the methods of appraisal. It's important you understand the principles that underlie each of the methods of evaluation. Traditionally, the net present value. The net present value will come along with a couple of issues. Remember the way we calculate issues in relation to capital allowance? Okay? Especially the final year. If you remember, we said that when it comes to the capital allowance calculation, dealing with the issue in relation to reducing balance method, in the final year, we're not going to be calculating any capital allowance. All we would do is to be able to then find out what is there any residual value. Then we compare that, the net figure, we will take it on the tax rate and boom, we go. But something you need to understand carefully is that although in the question the examiner will say, oh, the entity can claim capital allowance as 25% reducing balance, that is not the capital allowance. That is the depreciation. Because the capital allowance, or what you may know as tax benefit, is actually your depreciation multiplied by the tax rate. So when the question says, which the examiner will do, that oh, the entity can claim capital allowance on 25% reducing balance basis or 25% straight line basis, that is the depreciation. So whatever figure you get from that, you will express the tax rate on it, and that gives you the tax benefit or the capital allowance. It's important you understand that. Number two is to understand the issue about real, you know, items or real cash flows, and then the nominal cash flows. We said the real cash flows are the cash flows in real terms. And if the cash flows are in real terms, you have to use real cost of capital. If cash flows are in nominal term, you have to use the nominal cost of capital. In nominal terms, it means we are building into the system inflation. We're building into the system inflation. We're building into the system inflation. But like we said, sometimes the examiner is going to be getting excited. So it will give you real cash flows, but then nominal cost of capital, or nominal cash flows, but real cost of capital. It means you have to bring them to an equal ground. And one way of bringing the rates into an equal rate that you can express on the cash flows given will be to use the Fisher formula. It will be given. Will it be given? Yeah, I think so. It will be given in the exam hall, the Fisher formula, because you'll be given the discount factor. So I think the Fisher formula will be part of the discount factor. But make sure you know it as well. But you're expected to be given. So that is a principle that we need to understand as well. Then certainly the issue in relation to the fact that you're going to be applying the marginal costing principle here. Okay? The marginal costing principle. What does that mean? It means that any non-cash item will not be considered in investment appraisal. Okay, when you're dealing with MPV, no non-cash item will be considered. Number two, it means that any absorption of overheads will also not be considered. Okay, only specific fixed costs will be considered. Number three, it means also that any cost that has been incurred in the past is referred to as sunk cost. So in our investment appraisal schedule, it's not going to be coming on board. It is important you understand the marginal costing principle may be playing a role here when you are doing net present value. Then the last thing here is going to be working capital. The concept of working capital simply means the money that is needed throughout the life of the project. Now, the principle here is this, that any working capital that is required as an outlay must come as an inflow at the end of the project. Very important. So if it is a working capital just that they need just one time, then that one time it will be an outflow, but at the end of the project it will come as an inflow. But if the working capital is spread over a number of years, then in subsequent years, we only take into consideration either the increase or decrease in the working capital. But at the end of the period, the net amount will come as an inflow. Let me take that again. If the working capital is needed in just one period of the investment, then it will be an outflow in that period, but will become an inflow. So for instance, if the examiner says that working capital of $100 is needed at the beginning of year one, please be careful. At the beginning of year one simply means we need to pay it in year zero. So it will come under year zero as an outflow, but when we get to the end of the project, it will come as an inflow. However, if he says, oh, the working capital for every year is 10% of the sales, then you're going to calculate 10% of the sales. Then you have to look at the incremental working capital, the change in the working capital. That is what will come in the subsequent years. We explained that principle well in class. Make sure that you know that very well, because that is going to feed into your ability to be able to get to your final question, or final answer. So the working capital management is also another crucial area that you need to understand when it comes to investment appraisal. Then the last thing here that we need to understand will be the issue about the schedule itself. If there is tax in the appraisal, there are two ways the examiner can say, hey, tax is paid immediately, or tax is paid as income is earned. If tax is paid as the income is earned, or tax is paid immediately, then the schedule will be the same as the life of the project. So that if the project has a life of 5, then the schedule will also be 0 to 5. But if taxes are paid in arrears, or 1 year in arrears, it means the tax for year 1 will be paid in year 2. So in that case, if the project has a life of 5, we're going to be bringing the 6th year. But you got to be careful. that CFA you are bringing, there are only two items that can be entered there. That is the tax and the tax benefit. You got to be very careful about that, because that additional year you are bringing is for the tax. So there are two things and two things only. All other things being equal, 99.9% of the time, that will come under that extra year you are adding to the normal life of the project. And that will be the tax and the tax benefit, because the tax benefit or the capital allowance goes with how the tax is paid by the company. So that is the issue that you must understand also when it comes to the net present value. It is one of the formulas that has a lot of things that you have to really, take into consideration generally when it comes to investment appraisal. What do I have? um Sir, please, what about opportunity cost? Should it be included when calculating NPV? Yes, certainly. Opportunity cost, is part of, like I said, is the marginal costing principle. Opportunity cost is a relevant cost. So it's under the marginal costing principle. So, yes, certainly it has to be included in the schedule. Augustine, it'll be included. So if due to the project there is something that we cannot do for a number of years or whatever the heck, then that money that we'll be losing or that contribution that we'll be losing must be brought into the flow, and we must consider it. So yes, opportunity cost will be considered. That's why I mentioned that all the marginal costing principle you know about will be applicable here. All right, will be applicable here. Now, that's the first method the examiner can ask you about in the exam hall, NPV in that case. The second thing is IRR, internal rate of return. It also has a name, the break-even rate. Make sure if the examiner asks you calculate the break-even rate, you're not going to be doing a break-even point. Hey, fixed cost divided by contribution per unit. Oh, I can't get contribution per unit. Oh, hey, I see. Break-even rate is the same as internal rate of return, not break-even point. Because some of you, immediately you hear something, break-even, no, you are going to write break-even formula. You don't sit down and say, oh, break-even rate is different from break-even point. So IRR and then break-even rate is the same as also the rate at which NPV is zero. Okay, the rate at which NPV is zero. I mean, it's something that examiner can also ask you about in the exam hall. And when you're doing the IRR, it simply means you're going to be working for two different NPVs, and we explained this in class very well. B minus A. The formula will be given to you in the exam hall. I think so. IRR. I don't think so. You got to know this formula of head. It's better to know the formulas of head, okay? Know the formulas of it. So I don't. This one will not be given. You got to know it. So I mean, IRR can be asked. It means we're going to do two different NPVs. But I want you to be careful here, because the B is the higher discounting factor. A is the lower discounting factor. NPVA is the NPV at the lower discount factor. NPVB is at the higher discount factor. The clue is simple. When you do the first NPV, if no rate is given to you in the question, then start with 10%. So if you do the first one and the NPV is, positive, that means that the rate is too high. So we're going to be reducing it in the subsequent uh, issue. But if you do it and it is negative, it means the rate is too low. So we're going to be increasing it at the subsequent one. But the idea is that we're going to be calculating two different NPVs in this environment. And relatively, it's going to be simple, straight to the point in this regard. So that is the internal rate of return. The decision around that NPV is that if the NPV is positive, accept the project. If it is negative, would you go bye-bye? We don't accept the project when it comes to dealing with the NPV here. IRR, we expect the internal rate of return should be greater than the company's return. That is the return that the company wants. If it is greater, we undertake the project. If it is lower, we don't undertake the project. So that is the IRR, or break-even rate, or the rate at which NPV is zero. Then we can have the accounting rate of return, and we can have also the payback period. The accounting rate of return you are calculating, it's like ROSI. If you remember ROSI, that's the accounting rate of return. It's just like ROSI. So we are calculating our profit, okay? The average annual profit divided by the average investment. That's accounting rate of return. So here you're going to be considering depreciation. Okay, unlike NPV where we don't consider depreciation, in accounting rate of return you're going to consider depreciation, because it's just like ROSI, average annual profit divided by average investment times 100. The decision rule is simple. If the ARR is greater than the company's cost of capital, we accept the project. If it is lower than the cost of capital of the entity, we reject the project. Then the last thing is going to be payback. How long is going to take us for us to get our initial capital outlay? But we have the payback and the discounted payback. The payback doesn't take into consideration the time value of money, but the discounted payback takes into consideration the time value of money. But the two methods have some disadvantages, because number one, they don't consider the cash flows after the payback period, and it is important you understand that. So these are the methods, and there are theories under each of the methods. Like I said, the examiner can just go theory. You're going to write English throughout. So please remember the advantages and disadvantages under each of the methods when it comes to the investment appraisal. Then the principles that underlie the way we calculate all of them. The last thing is going to be sensitivity analysis. Sensitivity analysis is simply what is called what if analysis. The idea simply is that, what if, the assumptions we use to prepare the NPV schedule changes? What if? So we can calculate the sensitivity of, if it's a cost item, whatever the heck, it's going to be the present value of the project divided by the present value of the item in question times 100. That's how you calculate sensitivity. Okay, the present value of the project divided by the present value of the value, the present value of the item in question, and then that is going to be giving you, the sensitivity of the project in that case. If it is a cost item, it means that if it increases by that percentage you got, the NPV of the project will go to zero. But if it is a revenue item, it means that if the revenue falls by that percentage, the NPV of the project will go to zero. And that is the idea about sensitivity analysis. And that is what you must understand when we talk about investment appraisal. It's an area that the examiner is going to be getting some goosebumps with you on. Either going to be the theory issues or a mixture, some theories and some calculation for 15 marks in the exam hall. If he's excited, probably 20. He has never really done 20. He has always done around 15 in the exam hall. So that is the issue about investment appraisal. If there are any other questions, you can raise your hand and bring you up, or you put it in the chat for me there. Okay, so let's go to the next one. Let's see if I have some questions coming in from here. So the network, it's not helping. Okay, I think I've already handled that. Okay, let's go to audit. What do we have? Next one is audit reporting. 20 mark area if the examiner gets goosebumps. 15 if he doesn't like you. Audit reporting. It's waiting for you in the exam hall. Audit reporting. So after gathering our procedures, like we have discussed here, carrying out the audit procedures, we go to the final part, and that is audit reporting. All right. Now, so here there are a couple of issues that the examiner can come from. Subsequent event. What is the responsibility of the auditor when it comes to subsequent events? It is important the auditor inquire from management the procedure for identification of subsequent events. That's the number one. Number two, the auditor must inquire from management how the subsequent events are being treated in the financial statements. That's important because they are important there. And as you know already, the auditor, we have to look at adjusting events and non-adjusting events. And if they are adjusting events, then we have to request that management amends the financial statement. But chances are the management is not going to accept. So in other words, they're going to refuse amendments of the financial statements due to the subsequent event. And we have stated that if management refuses to amend the financial statement, what procedures should the auditor undertake? So you realize that you are in audit reporting, but the examiner could still ask you a question about audit procedures, right? So management is supposed to amend the financial statements because it's an adjusting event or the event that has happened is material to the financial statement. But management has refused. What is the or what should be the response of the auditor? We said number one, the auditor must discuss the matter with management. The auditor must inquire from management the reasons for their refusal to amend the financial statement. The auditor must discuss the issue also with the audit committee and let them know and let them recommend to management for them to do the right thing. If it still doesn't stand, then the auditor must inform management the implication of the non-adjustment on the type of audit opinion or audit report that is going to be issued. Because, like we said, we are not creeping behind management and then shock them. So they are there now, then we come and say, hey, we have published our auditor's report. And you didn't know. We have to tell them the kind of audit report we're going to be issuing, whether a modified audit report or an unmodified audit report. If it's an unmodified if it is a modified audit report, what opinion are we expressing? I'll come back to that in a sec. But that's the idea about subsequent event. We have to know about that. Two, goodwill. Okay? Goodwill. Very important. Did I say goodwill? No goodwill. Sorry about that. Going concern. Adi Nhyira. Going concern. Now, going concern, like we said, is the ability of the entity to continue to operate in the next 12 months, okay? Not into the foreseeable future. That's nonsense. Just the next 12 months. So, can the entity operate in the next 12 months? That's going concern. Remember, the examiner can ask you the audit procedure that the auditor must take in respect of going concern. And we said, going concern assessment is the sole responsibility of management. So it is management responsibility to assess the going concern of the entity. And when management is assessing the going concern of the entity, among other things, they are going to be preparing a management accounts report. So the management accountant is going to be preparing a report which will be having whatever a cash flow forecast or some prospective financial information to prove that, oh, we can continue as a going concern. It's management responsibility. What does the auditor do? The auditor's role with going concern is to number one, review the management assessment of the going concern. Number two, inquire from management the basis of the assumptions used in the assessment of the going concern. Okay? And then what is the source of the assessment? And then inquire from management if there are any documentation that they used, then we have to obtain a copy of those documents and review those documents as part of our procedure. But after we gather the evidence and get the basis that management used and the reasonableness of those bases, the auditor must reperform the going concern status or assess the going concern status so that they can find out whether they can corroborate that with management assessment at the end of the day. That is the idea about going concern. But also, most importantly, we spoke about indicators of going concern issues. There are certain things which, when present, can indicate that this entity may not be able to operate into the foreseeable future. Maybe loss of a key customer, loss of a key supplier, loss of key management personnel, loss of key employees. Maybe a factory is burnt and there is no insurance on it, and or the company's debt is due, they don't have any money to be able to repay it, and the banks are not ready to refinance the company's debt or give them an extension of their debt. All of these things can be indicators of going concern issues. But like we said, the fact that there are indicators doesn't mean we end there. Because if management have in place mitigating factors which auditors can corroborate that these mitigating factors are reliable, then it is no longer an issue. But it is only when management mitigating factors cannot be reliable, then in the auditor's report, the auditor will bring a paragraph that will be headed as uncertainty about going concern of the entity, or uncertainty about going concern. That will be a paragraph, and in that paragraph, the auditor will share his view about why they are not sure about management assessment, as they have done their own assessment about the ability of the entity to continue as a going concern. That doesn't modify the auditor's opinion. It is just an additional information being included in the financial statement, being included in the auditor's report for the users to know about. That's the issue about going concern. It's something the examiner can ask you about. 3. Other information. Like we said, although we are there to audit the financial statement, there are other information that we need to also review, like the management minutes, the board minutes, the management accountant's report, the director's report. All these are other information that we have to review during our audit. Why are we doing that? Because we want consistency, so that if there is something in the other information which can be traced to the financial statement but it's not consistent with the financial statement, then we have to take further actions in respect of the procedures we undertake. And we discussed a question like this during our mock session, and you saw the way we structured that out. Then the last thing is to come to the audit report itself. Remember, we spoke about the format of the audit report. You will not be asked to write an audit report, but the examiner may ask you to critically appraise the auditor's report. It's an area that the examiner enjoys a lot because many students are not able to pay attention to the format of the auditor's report and they write a lot of nonsense. So the examiner enjoys that area. So please, we did that. Before you get to the exam hall, make sure that you look at the format of the auditor's report. The auditor's report is addressed solely to the shareholders. We open up with the opinion paragraph, and the opinion paragraph must state the financial statement that we audited explicitly and must state the opinion that we are expressing explicitly. The basis of opinion has to do with how we reach that opinion. So in the basis of opinion paragraph, there are items that must be there. The reason that we reach the conclusion, how we undertake the audit in accordance with the ISBA Code of Ethics, that must be stated explicitly. So the format of the auditor's report, it is important you know that, because the examiner may ask you to critically appraise an audit report. Then the audit report itself, whether we are issuing a modified audit report or unmodified, okay, or unmodified audit report. So are we issuing a modified audit report or an unmodified audit report? That is a question that the examiner can ask us, that we need to understand. But you got to be careful, because in an unmodified audit report, we are expressing an unqualified opinion, which means the financial statement taken as a whole represent the true and fair view of the entity. But in a modified audit report, we may express one of the three type of opinions, and that is the following. One, the issue in relation to except for, or what we call a qualified opinion. Then a disclaimer opinion. We cannot express an opinion on the financial statement. And then diverse opinion, or what we call an adverse opinion, which means the financial statement taken as a whole does not represent the true and fair view of the entity. But remember, we said the modification of the audit report depends on two things. That is the materiality of the subject matter in question, and then the pervasiveness. The materiality and the pervasiveness. Pervasiveness is the effect of the item on the financial statement as a whole. So if the item is material but not pervasive, then we said that the auditor can issue an except for opinion, which means the financial statement taken as a whole represent the true and fair view of the entity with the exception of that particular item. Now, two, if the item is material and pervasive, it means the financial statement taken as a whole is smelling. So we issue an adverse opinion or a diverse opinion in that particular case. Now, these two will come in if we are able to gather evidence about the subject matter. If we're able to gather evidence about the subject matter. But if the item is material and pervasive, okay, pervasive, but the auditor is unable to gather evidence, probably because management placed in or put it in their path hindrances, then the auditor must issue a disclaimer opinion, meaning we cannot express an opinion on the financial statements. That is the idea about audit opinions. Any question? That is audit reporting. So your questions will be coming from these four areas. Probably two of them for the 15 marks minimum. 20 marks is where the examiner is excited about that. But that is audit reporting. You're going to be seeing something about it in the exam. Give me a sec. Let me plug my device. All right. So then, please, Emma, can you take break even for multiple products? I've spoken about short-term decisions. You didn't ask the question. I was talking about short-term decisions there. Okay, I'm going to management accounting anyway, so maybe I can talk about that. All right. So everybody good on this one. Let's see if I have any comments coming in online. Then I can uh look at this. Let's see if I can pull this up. Also then, hello sir, Abdul Ganiu Baba is my name and I'm watching you live from Northern Region Tamale. All right, thanks Ganiun. Also then, okay, for joining us. Uh, what the heck? Say, can you help explain the auditor's report on fraud and errors? I don't understand. What do you mean by auditor's report on fraud and errors? Auditor's report on fraud and errors. There is nothing like that. I don't know what you're trying to ask, though, but if you can be specific on what the heck you're trying to ask, because I don't think there is anything like auditor's report on fraud and error. I don't know. At this point, people are shacking above my pay grade. I think this question will be above my pay grade then. I don't know anything about audit reports on fraud and errors. I don't know. Like I don't get a context. So maybe give me something specific, then I can work with. Okay, give me something specific then I can work with. Okay, so let's go to management accounting then, if I'm okay here. Let me take the question that was asked here. Um, I don't think she's even on the call, so let me not even answer that because the person who asks the question is not on the call. So I mean, oh, okay, you are here. All right. I don't know. Let me still. Oh, okay. So let me just address that. So back to management accounting. Now, break-even point for multiple products. I mean, if an entity is selling multiple products, then calculation of the break-even, becomes a little bit different. So usually we're going to be looking at the issue in respect of the break-even point in value. And if you're calculating the break-even point in value, we're going to have the fixed cost, all right, divided by the weighted average, the weighted average CS ratio, okay, for multiple products. Now, how do you calculate the weighted average of the CS ratio? Simple. You just have to, calculate the issue in respect of the total sales. So maybe they have selling three products: product A, product B, product C. Okay, we're gonna have the sales of product A coming up. Then we'll have probably the contribution. You're gonna calculate contribution for each of them. All right. Then you're gonna have your total columns coming here. So you add the sales together, okay? Then you add their contributions together, and then your weighted average contribution to sales ratio is going to be the total contribution for the three products, if it is three products the company is producing, all right, divided by the total sales for the three products times 100. So that is how you get the weighted average contribution to sales ratio. That's how you get a weighted average contribution to sales ratio. So once you have that, your fixed cost, the scenario will be given for you to be able to calculate the total fixed cost of the company, not fixed cost for each of the products, but the total fixed cost of the company, then divided by your weighted average contribution to sales ratio, and then that will give you the break-even point in value in that case. So that from there, in case you want to calculate your margin of safety, then you can do that calculation by bringing in the total sales that a company budgets to sell minus the break-even point in value. Then you can get your margin of safety. So in a multiple environment, that is how we calculate the break-even point in value in that particular case. For the break-even point in units, I mean, you remember we have to go through some steps. I mean, that is a quite an extended step, a little bit. I will not be able to go through that uh, now because we need to calculate the contribution per unit for each of the products. All right. Then we need to calculate the contribution per mixes. All right. Now, the contribution per mixes will be the contribution per unit multiplied by the sales mix. Because when the company is in a multiple products environment, we are going to be given the sales mix. The sales mix simply means what is the ratio of sales for each of the products. So let's say we are doing what? Condoms, whatever the heck. Let's say we do condoms, we do sanitary pads. What else can we do? Diapers. Okay. So the sales mix simply means that okay, when we sell two packets or two packs of condoms, we will sell, four sanitary pads, and then we will sell whatever, five diapers. So this is going to be the sales mix. So the sales mix will become what we will use to multiply the contribution per unit to get the contribution per mixes. So like I said, that one go through the steps. You can refer to your notes on that because the steps is a little bit extended to be able to help us to then calculate the contribution per unit for the individual products. But in the per value, we apply the weighted average contribution to sales ratio to do the calculation there. So let me know if that makes sense for you in that case. Okay, so let me go back to my slide, management accounting. Okay, that's good. Go back to my slide on management accounting. Okay, what else? Standard costing and variance analysis. What can I say about this, guys? It's gonna be there for you. I mean, what can I say about them? Let's see what I can say. Let's put this here. So 15 marks, max 10 if the examiner doesn't like you, and that is going to be the idea in respect of the standard costing and variance analysis. The deal here is simple. We're going to be applying marginal costing and activity based, sorry, marginal costing and absorption costing here, but I'm going to show you that in a sec. So number one, the direct material cost, variance. Okay. Then the direct material price variance. If you remember, we said the the direct material cost variance is actually made up of these two guys. The direct material cost variance is made up of the direct material usage variance and the direct material price variance. If you remember, the idea is that the direct material usage variance is based on what? The actual units produced. mm, the actual unit produced. Okay, so the actual units produced, how many kilograms, how many grams of material should we have used based on the standard? And how many did we actually use multiplied by the standard cost per kilogram or whatever the heck unit of measurement? Material price variance is based on the actual material that we bought. Okay, actual material that we bought. So for the actual material that we bought, how much should we have paid based on the standard cost card, and how much did we actually pay? That is the idea about the direct material price variance. But we said that when the company is in a multiple product environment, sorry, multiple material environment. In other words, for the finished product, they will use more than one material. So if for the finished product they will use more than one material, then the examiner may request us to use the material mixed variance and the material yield variance. The material mix variance is going to be assessing the combination of material that we used based on the standard. And so you remember the format of the way we do the calculation for the material mix variance. We said you're going to bring the standard mix in actual quantity and then actual mix in actual quantity, right? And we said the way you go by this is to just bring the actual material used. This is the actual material. Just bring it there, get the totals here, bring that total here, and you're going to share this total between whatever materials we are using to get the standard mix in actual quantity. But you're going to use the standard cost card mix. So whatever the heck, let's say we are manufacturing condom, all right, and we need to use some lubricants and we need to use some latex, okay, or some rubbers, whatever, latex. Then on the standard cost card, lubricants maybe 2 kilograms. I don't know, do we measure that? Just take it. Latex we use also whatever 4 kilograms. So it means each product we're going to use 6 kilograms. So the total that you brought here for the actual material, you're going to be sharing it. For the lubricants, 2/6 times the actual. For the latex, 4/6 times The actual. Those are the figures you will bring under the standard mix in actual quantity. Then when you finish, you get your difference and you get your standard cost, and then you get your variance coming up. So that is the material mix variance. We are looking at the combination of the material that we have used as compared to what we should have used based on the standard cost card. The yield variance, like the name suggests, is about output. So for the total material that we've used, how many units should we have produced and how many units did we produce? And that is if we are doing the yield in total. Then once we are getting the difference in units, we have to multiply that by the total direct total standard direct material cost per unit. The total standard direct material cost per unit, and you have to work for that in the exam hall. So that is the idea about the direct material usage variance. Okay, now remember there are theories here, just like what we discussed in the mock. That sample question is something that the examiner can throw at you that you have to be mindful of when it comes to that. Yes, Ernestina.
Nhyira, please, with the yield variance. So in a case where you have the standard cost and you have the standard contribution, what is ideal to be used?
What?
When you have contribution,
Right.
a standard contribution, and you have a standard cost, when you get I saw a question where they use the contribution
Hey.
and they had a standard cost, but then they use the contribution in multiplying the differences to get the variance.
No, no, no. It can't be done. That's a lie. It's wrong. You can't do that because you are doing materials. So you can't use contribution. So you have to use the total standard direct material per unit. So if I go back to my
No, no,
illustration,
Ishra, they didn't solve it in totals. They did it individually. So
no,
you know the individual one.
when we are doing individual, we still don't multiply by standard contribution. We multiply by the standard material cost per kilogram. We still cannot
Okay.
multiply by contribution. So that will be an error. That will be an error.
Okay.
Okay.
Thank you.
Okay. So that is direct material. Then we flip the coin up a little bit and then we come to direct labor. So direct labor cost variance, that's also in two. Direct labor rate variance, direct labor efficiency variance. Please note, the examiner can ask you to calculate the direct labor usage variance. Is the same thing. And the examiner can ask you to calculate direct material efficiency variance. Is the same as the usage variance. So you're going to say, Ishran didn't teach us direct material efficiency variance. Is the same as direct material usage variance. Yo. Now, so the direct labor rate variance depends on the actual hours paid. Be careful here. It depends on the actual hours paid. So for the actual hours that we paid for, how much should we have paid and how much did we pay? But the direct labor efficiency variance is based on the actual units produced, okay, taking into consideration the actual hours worked. Two different things. Actual hours worked is different from actual hours paid. So for the actual units produced, how many hours should we have used based on the standard, and how many hours did they actually work? You get it? Now, if there is a difference between the hours we paid and the hours they worked, the difference is the third variance that comes here, and that is the idle time variance. That's it. We done. We done. Now, just to backtrack a little bit and show you something, under the direct material price variance also, the direct material price variance is vague. It doesn't give us a lot of things. So we could also divide that into two categories. We have the material price planning variance and the material price operational variance. The material price planning variance, like the name suggests, is assessing the efficiency of the budgeting system, okay? The efficiency of the budgeting system in the procurement department of the company. For that reason, the material price planning variance is usually equal to the standard price, okay, minus the general price at the time of purchases. General price at the time of purchases. So that if the procurement department say, oh, we're going to pay $10, but at the time that we were buying, the price is $25, that means they didn't budget well. Or they budgeted well and something happened and the economy or something, Israel is killing Ukraine people, or sorry, Israel and Palestinian is fighting, so that is why, or whatever the heck, but we don't know. But it's measuring the efficiency of the budgeting system in the procurement department. That is the material price planning variance. Then the next one is the material price operational variance. This has to do with the procurement techniques, the efficiency of the procurement, come on, Nhyira, you can do better. Procurement or the negotiation skills of the procurement department. How efficient are they? So the material price operational variance, it's about the actual price paid, all right, minus the general price at the time of purchases. So if we paid $10, but the general price at the time of purchase was $7, why did we pay more? Is it because we changed material? Is it because we changed a supplier? Is it because we are buying less? Is it because there is an economic crisis? What's happening? Why are we paying more? Are we buying on the black market? I don't know, but that's the idea. So the direct material price variance can further be divided into the material price planning variance and the material price operational variance, because that gives us a better understanding to actually assess the procurement department of the company. Give me a sec. To actually assess the procurement department of the company. That's the idea about that. Okay. Then, you come to the overhead variance generally. The overhead variance, it will depend on the environment we are in. If we're in the absorption costing environment, remember the things we are supposed to calculate there. If you're in the marginal costing environment, remember the things we are going to be calculating there. In the marginal costing environment, we are likely to just be focusing on the expenditure variance, efficiency variance. These are the two things, whether variable or fixed, these are the two things we're going to be considering. But if we are in the absorption costing environment, we will do expenditure, we will do efficiency, we will do capacity, and we will do volume. But if you remember, we said the volume variance, the fixed overhead volume variance, is actually the addition of the efficiency variance and the capacity variance. You remember that? We said it. So when it comes to the overhead variances, it will depend on the environment we are in and what we have to calculate. So you got to be mindful. If nothing is stated in the question, then we will assume that the entity is in the absorption costing environment. In that case, we'll calculate the fixed overheads expenditure variance, fixed overheads volume variance, fixed overhead efficiency variance. You get the idea. I'm not going to go through everything like that though, but you know the idea. if I say I will take every one and talk about them, and but you get the idea. It's important there. Then the last thing is going to be the sales variance. Two things here: sales price variance and sales volume variance. You got to be careful here. Sales price variance depends on the actual units sold. So for the actual units sold, how much should we have sell it for, and how much did we sell it? Sounds good? So if we sold 100 packs of condoms per our standard, what was the selling price? So that, and then how much did we get when we sold it? That is the sales price variance. And one thing I want you to take away from all these under the variance analysis is that if we're in the cost environment, if our standard exceeds our actual, then that means that it's a favorable environment to be in. Okay? If our standard exceeds our actual, it's a favorable environment to be in. But if our actual is more than the standard, that's an adverse environment if you're in the cost issues. But when we are in sales, which is about revenue, then if your standard is less than the actual, is adverse. And if your actual is more than the standard, is favorable. Be careful and know that. Now, the sales volume variance doesn't come cheap because it depends on the environment we are in. Nonetheless, the sales volume variance is about just the budgeted unit minus the actual unit, and you get your difference. But the difference must be multiplied by the standard either contribution or standard profit. We will do standard contribution if we are in the marginal costing environment. We will do standard profit if we are in the absorption costing environment. So calculation of the sales volume variance also depends on the environment the company is in, on the system that the company is using. If it's the absorption costing environment, then we're going to be calculating the standard profit. But if we're in the marginal costing environment, then we're going to be calculating standard contribution. It's important you understand that. Now, if the company is also in, I said, oh, okay, this is the variance I saw. Oh, okay, I see. So this is what you saw anyway, giving us upper bonnie. Oh, goodness and mercy. And it still will not kill me at this point. Okay. Now, if the company is also selling more than one product, then we will have to calculate the sales, if we are selling multiple products, then we have to also have the sales volume splitted into two. That is the sales quantity variance, and then I've forgotten the second one. It has mixed me a little bit. I can't remember it. I don't know why. I've forgotten the sales quantity variance, and then there is one. But the principle here is just like the sales mix. Okay, and then the material mix and the material yield. It has the same notion, the same principle. So if you remember in class, I told you that if you remember the sales mix variance, then you can do the sales volume when a company is selling more than one product in that particular case. No, Ernestina, you can't do me like that. You can't say that tutor can't remember whom am I. No, you can't say that now. You have to cut me some slack a little bit, that there is a lot going on in my brain at this moment as I'm trying to mix audit with management accounting. So you have to cut me one slack. This is the only thing that I've forgotten. I don't know why I've forgotten the second one. I don't know. I think I'm trying to still remember though, because it's not fair. I'm supposed to remember it. It's not fair. I'm supposed to remember it. I don't know. I don't know. I think sales quantity variance or whatever the heck. I mean, Charlie, refer to your notes. I mean, I can't remember that one. So that is the idea about that. And the last thing is gonna be the preparation of the profit statement. Okay, or if you want a statement of reconciliation, profit statement or statement of reconciliation. Please remember we said the preparation of that statement depends on the environment we are in. I beg you, before you go to the exam tomorrow morning 9 a.m., refer to that statement. It's something the examiner can throw at you. Know the way the pro forma goes when we're in the marginal costing environment. Know the way the pro forma is when we're in the absorption costing environment. The pro forma is only going to be affected in the very beginning, but look at the pro forma and go through that very well. That is the idea about variance analysis. But also here, there are a lot of theories here, like types of standards. And there are 4 types of standards: ideal standard, current standard, attainable standard, non-attainable standard. These are written questions the examiner can ask you for 5 marks. Please make sure you read that, and I hope you have read it. Then, the importance or objectives of standards. It's a question the examiner can throw at you. Make sure you read that and make sure you understand that. And then the last thing is going to be the reasons why a certain variance will be favorable or adverse. It's something that the examiner has not really been excited about, so make sure you learn them. So if the direct material price variance is adverse, why could that be? And then if you look at our question that we discussed in the mock, that structure of question also has not been asked. The variance question we discussed in the mock, the written part, that type of question or that structure of question has not also been asked really by the examiner. So for the theory and comment aspect, you make sure that you pay attention to these very well. These are the things that you must understand when we talk about variance analysis. Any other questions for me on standard costing and variance analysis? Okay, so let's go to the audits. And I think we are almost done on the audits. Next thing is going to be public sector auditing. What can I say there? I don't know. A lot of things there I can flex around. So public sector audit. There are a lot of things here that the examiner can ask you about, and I've told you make sure you read on the roles of the, Auditor General, Public Accounts Committee, Audit Committee, Internal Audit Agency, Internal Audit Units or Internal Audit Department. Okay, you know these are things that the examiner can throw at you as a starter in the discussion. Then number 2, the issues about the types of public sector auditing. We have the performance. Performance audit is carried out after an entity has undertaken a specific activity. So maybe the Ministry of Roads and Highway, they constructed a road. Maybe they constructed a 10-kilometer road. So we will do a performance audit on that construction. Or the Kolebu Teaching Hospital, they built a new department. Okay, we come and do an audit on that particular thing. Or the Ghana Education Service built a new library or a new school blog for a certain school somewhere or a certain community. We can do a performance audit on it. And when we are doing performance audits, a couple of things we are looking out for. Number 1, we want to find out whether value for money was achieved. In other words, what is the cost? Is the cost relatively cheaper, economic, efficiency, effectiveness? So we are looking for value for money. Number 2, we want to find out whether the contract was awarded in accordance with the Public Procurement Act and or with guidelines from the Public Procurement Authority. In other words, did they follow the procurement rules in the award of contract. That is what we want to find out in performance auditing. But there is also what is called compliance audit. This has to do with assessing whether the entity's operations are in line with the acts or the laws that establish them. Number one. Number two, whether their activities, their operations are in line with their own internal controls. And then number three, whether their activities are in line with any guidelines or directives issued by Minister of Finance, Controller, Accountant General, Auditor General, or even Parliament. That is the idea about compliance audits. It's the entity's operations in line with the laws, the act that established them. Their own internal controls, are they carrying out their work in line with their own internal controls? Then the directives of the Ministry of Finance or Minister of Finance, Controller, Accountant General, Auditor General. That is compliance audit. Then the last thing is going to be financial audit, which you know already. So in financial audit, it's the audit of the financial statement, and so there is a little performance audit in there and a little compliance audit. So in the financial audit, the auditor general or the auditors are going to be looking out for value for money. Did they procure goods in accordance with the Public Procurement Act? Did they spend money in line with the appropriation approved by Parliament? Did they carry out their work in accordance with the Public Financial Management Act 2016 Act 921? Did they follow the due processes available in the financial administration regulations? So the financial audit is about the financial statement, but there is a certain element of performance and there is a certain element of compliance with other issues that we need to look out for. So these are the three issues that we need to understand. Now the goal here is that the examiner can be generic. In other words, he can ask you to just write on the types of public sector auditing. In that case, you're going to flex your muscles and then talk about these things at the end of the day. But number two is that the examiner can give you an illustration. Like I said earlier, the Ministry of Roads and Highway constructed a 10-kilometer road. Explain the audits that the controller, that the auditor general can carry out on that activity. Then quickly you must know that it's a road they have constructed, so it's a performance audit that we need to undertake. You got to understand that. You got to know about that. Okay. So the examiner can give you a scenario. Then in that scenario, you have to know the kind of audit, the type of audit that we have to undertake there in the question. So that's the idea about the types of public sector auditing. Then we can also talk about the issue in relation to outsourcing. I mean, of public sector auditing. You know, if the auditor general is unavailable to undertake the issue in relation to the audit, then the auditor general can approve the appointment of a private audit firm to be able to carry out the audit. And there are advantages of outsourcing, disadvantages of outsourcing. But most importantly, will be the factors that an audit firm will consider before accepting to carry out any assignment in a public sector entity. That's a question the examiner can ask you. And we discussed that in class very well. We said that we need to consider the subject matter, who the management are, what is the public interest in that particular matter that we have been asked to come and carry the procedure on, what kind of reports are they expecting us to issue at the end of the day, what is the risk that is associated with that particular engagement, and is there any politically exposed person, so that for instance, if the head of that particular organization is the son or the daughter or the family relative of the president or the finance minister or whoever the heck, then that kind of assignment assignment is going to be very sensitive because it's likely that if we screwed up, we will be screwed up at the end of the day. So we have to consider, is there any politically exposed person in the organization as part of the management that we have to be mindful of? So all of these things are, public sector auditing that we can be asked about. Then in the context of the issues that we discussed during our mock, also the examiner can throw some questions in this particular case that we need to generally know about when it comes to public sector auditing. When it comes to public sector auditing. So that is the idea about public sector auditing. So the examiner can come from any angle. Remember the procedure, audit report. Everything here is the same as what we know in the private sector. Only that here we are going to be talking about INTOSI, okay, because we are dealing with the ICAG here, okay. The Auditor General is the supreme, how do we call it, the supreme audit, the head of the Supreme Audit Institute. The Supreme Audit Institute in Ghana is the audit service, and the head of the audit service, who is the head of the Supreme Audit Institute, is the Auditor General. So in the public sector, we're going to be using the ICAG, that is the International Standards of Supreme Audit Institute, in the carrying out of audit engagement. But relatively, the audit procedures, the planning, the audit reports, the modification of the audit reports, all of those things are going to be the same thing when it comes to dealing with public sector auditing. So please make sure that you know about that when the examiner would want to throw you something there, then you can answer that particular question as well. So that is the issue about public sector audits that you must understand. Okay, so that's public sector auditing. Then there is something in audit reporting that I think I didn't tell you about, but probably you have to know about. That would be like, oh, good. I'm trying to remember the thing. It just came, but it has gone again. I think hot review. It's a kind of review that is undertaken prior to issuing the auditor's report. So before they conclude and they sign auditor's report or they issue the auditor's report, they undertake what is referred to as a hot review. Okay, and usually that review is undertaken by the engagement partner, that is the senior people in the audit. Hey, is everything right? Are you sure you guys did everything right? Give me the working paper. When you identify this, what procedures did you undertake? Okay, everything is right. Okay, so on the basis of this, we will issue an unqualified opinion. Then boom, that's a hot review. Okay, so I don't know, it's just something that you need to know about because the examiner can throw that at you in that particular case. Then I'm seeing a question coming in here. It says, what is code file? A code file is simply any audit file or audit document that has been uh, completed and, sign off. So for instance, if you are the one who is supposed to audit, say, trade receivables, and you have finished auditing the trade receivables, you've signed it, given it to your supervisor, he has looked at it that everything is okay, we sign it, that will be part of the working paper. That becomes what we refer to as what? A code file. Because we have, brought the details on the subject matter, we have reviewed it, we have fully audited it, and we have signed it off that we are done. And we are not going to go back to it. That is the meaning of code file. The person who asked the question is not even on the call. All right. Okay, so that's public sector auditing. Any questions for me? Advanced audit and assurance students here? I don't know. Oh, goodness. I think haha, my time is, oh goodness. I think at this time I have to leave you guys to go. Say we and then be on mope. Let's see, Emmy. What else have I not talked about? Okay, budgeting, right? Budgeting. So budgeting is going to be in the exam hall, and we mentioned that it is important you understand that very well, because I don't want to keep you guys a lot here. Although I want to go through the entire syllabus, I also have to let you guys go and go and study. It's very important. Don't want to keep you here too much. So budgeting, 15 marks is going to be in the exam hall. Most importantly, preparation of the functional budget. Okay, preparation of the master budget. Okay, then the theories. There are a lot of theories here in budgeting that the examiner will talk to you about. I've told you about them. Methods or types of budgeting: incremental budgeting, zero-based budgeting, activity-based budgeting, program budgeting, da 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 da, participating budget, non-participatory budget. All of those guys are things that the examiner can throw at you. But when it comes to the preparation of the functional budget, we start with a sales budget. Then we narrow down to the production units budget. Remember, in the preparation of the production unit budget, we have to build into the system defective what? Output. Remember that very well. Then we come to the material usage budget. The material usage budget will be based on the production unit, taking into consideration normal loss. So we have to build into the system also normal loss here, but it will depend on the context of the question. We have to build into the system normal loss. Then from there, we'll look at the material cost budget. How much do we have to buy? Sorry, material purchases budget. How much do we have to buy in terms of the kilograms or liters, and then in terms of currency as well. It's something that the examiner that you have to know about. From there, you come to the labor budget, which will be based on the production unit. But when you're doing labor budgets, two things you have to consider, one of which may be in the exam hall: the concept of idle time, which will increase the labor hours we need, or the concept of labor efficiency or labor productivity, which will reduce the labor hours we need. And also, like we saw in the mock, there could be built into the system overtime premium, because when people work more hours than we they are available based on the hours we need to produce the unit, then we would have to pay them overtime. And you saw the way we dealt with that during our discussion. So these are functional budget. The examiner can come from that angle, or he can come from the master budget, where you are preparing the budgeted cash flow, the budgeted P&L. Technically, here, like I've told you, your English is going to be very important. Your English is going to be very important. So that is the idea about budgeting as well, that you must understand: the functional budget preparation, the cash budget preparation. Your English is going to be very important, because you need to understand if there's going to be trade receivables or there's going to be credit sales, how do we collect the money? Okay, so if there is credit sales, how are we going to be collecting the money? It will be stated in the question. It's important you read and identify how the entity is going to be collecting the money. What's the percentage? What is the any bad debt? You must make sure you understand that very, very well. So that's the idea about budgeting that you must understand: the functional budget, the principles, the cash budget, and then the theories that you must understand in that respect. Nhyira, please explain time and a half and time and a quarter. Okay, so we said that if there is any overtime premium that has to be paid and it is time and a half, it's simple. So let's say that, hey, time and a half now, what you're there, time and a half. So it's simple. Let's say that, normal time for people to work is 40,000 hours. Okay? But the hours required is actually 42,000 hours. So it means they're going to work overtime for 2,000 hours. So if we are going to be paying them time and a half, it simply means that we are going to be bringing the overtime 2,000 plus half of the 2,000, okay, multiplied by the labor rate. That will give us the overtime. That is time and a half. Time and a half. Time and a quarter will be the overtime 2000 plus into bracket 1/4 of the overtime. Then we multiply by the labor rate, then we'll get our answer. So that is the idea about time and a half, time and a quarter. The idea simply is that bring the time, then add half of the time to it, if it is time and a half. Bring the time and add 1/4 of the time to it. That is time and a quarter. Does that make sense? So that's the concept about time and a half and time and a quarter. All right. Let me know if that makes sense for you. So I think, okay, I think we're done. I mean, what else? So, audit people, some introductory issues. You know those things already. Professional liability, expectation gap. You know, what else? Money laundering. I mean, those things. Those are introductory issues. Some tema question will come from there. Non-assurance engagement. There are a lot of them. Time will not allow me to go through all of them, but we discuss them in class. Prospective financial information, due diligence, forensic accounting, and all those other ones. Then computer assisted audit techniques. Make sure you read them because these are all introductory issues. The examiner can throw some 10-mark questions from anywhere there for you. But what we can guarantee ourselves on is ethics acceptance, audit planning risk assessment, audit evidence, audit reports, public sector auditing, then the non-assurance engagements, one of them will be there. I don't know which one, but one of them will be there. Forensic accounting is something that the examiner has not really visited because he has visited due diligence before. He has visited on a low-key prospective financial information before. He has not really visited forensic accounting. He has not, or forensic auditing. Then he has not also visited really, you know, review of financial statements as well. So probably this semester he would want to visit there for 10 marks. So please make sure you get some ideas about those things. Then also the issue in relation to where did you go? I didn't expect you to go. Agreed upon procedures. I told you about this one as well. The agreed upon procedure is simply where a firm appoints the audit a client appoints the audit firms and tell them exactly what they want them to do. It's called agreed upon procedures. So maybe we are going to count inventory at the reporting date. Then the entity will say, we don't have good people to count the inventories. They will employ an audit firm to come and count the inventory for them. It's called agreed upon procedures. Or the entity is thinking about designing an internal control system, but their audit team is not, their internal auditors are not well versed to be able to design internal controls for them. So the firm or the entity may appoint an audit firm to help design an internal control for them. That is an agreed upon procedure. Okay, then those things. So it's an area that the examiner could visit that you have to really pay attention to in that particular case. So my wrap up discussion, let me do audit first, then I'll come to the MA people. So auditing, we've said what we are supposed to say already. My final take for you is to make sure that you read the question carefully to know what you are supposed to answer. Don't just read the beginning of the requirement and conclude. Make sure you understand the context of the question so you don't digress. Okay? If the examiner asks you, what is the auditor's responsibility about something? Don't go and write procedures about the thing. Be careful. When the examiner asks you, what matters should the auditor consider? Don't go and write audit procedures. Read the question carefully. Number 2, your English. At this point, there is no hope for you if you have problem with English grammar. but we pray that you don't have problem. So make sure as much as possible you write well. Okay, make sure you write well. Your subject verb agreement, make sure you don't screw that up. It's very important. Okay, it's very important. Don't screw that up. So English expression, it's very important because it's a written paper purely. You're not going to be doing any calculation really. uh, you may be required to do some calculation because there is a question where the examiner will ask you, what analytical procedures should the auditor undertake? And you will be given a set of financial statements. Remember, if you are doing analytical procedures, you are comparing data and you are finding trends. So if you are given a set of financial statements and the examiner says carry out analytical procedures, then probably you have to calculate some ratios. So you have to calculate some profitability ratios, trade receivable ratios, days, trade payable days, so that you can do the comparison and find out, oh, the trade receivable days has gone up, the trade payable days has reduced. Why? So aside that kind of question where you'll be doing those ratio workings, because it is an analytical procedure, materiality calculation, that's all. Everything else, you go write English. So take your time, read question carefully, make sure you write a good English. Number 3, make sure that your answers are all in simple sentences. Okay? Your answers are in simple sentences. This is very important. Don't write a clause that cannot be understood. Simple sentences. Simple sentences. Now, if the question is quiet, but it says, what procedure should the auditor undertake? And you see, oh, 5 marks there. Then as much as possible, you can write 5 points. Simple sentences, 5 points. Okay? 5 points. The reason is that so that even if, the examiner is giving you 1 for each, you are okay. Because sometimes, even if you write 2 points and it's of the best quality, you can still get a full marks. Okay, so but how do you know if your point is quality? Some of you, because of your English and your lack of understanding of auditing, the quality of your answer will not be to the standard. So to prevent that, try to write small points as much as possible in simple sentences, well understood sentences, so that the examiner can spread the grace. Then when we add the spread up, it becomes a whole, so you can get some significant marks rather than just writing 2 where your English is not of the best quality. And this is not because, like I say always, that I'm, making fun of you. Yes, you speak something that sounds like English, but what you write in the exam or when it comes to advanced audit and assurance, it's a different ball game altogether, because there are terminologies, expressions, and things that you have to state when you're writing up. So when I say quality of your answer, that's what I mean. I don't mean that you don't understand English. You speak something that sounds like English, but it's different when you are writing it out. So make sure your answers are in simple sentences as much as possible. If you can write more points relatively without exceeding the time required for that question, write more points, because that will help you, so that if the quality of the point is not of the best, because you've written a lot, it can be spread across and you will relatively get more marks. But be careful, because some procedures are the same. That some of you, because of your greediness, some procedure, one thing, you will split it into 17 points or 18 points. Be careful, all will be one. So the fact that I'm saying try as much as possible to write more points as possible does not necessarily mean that if something is external confirmation, you decide to break it down into 3 different points. You just have to be careful about that. So read carefully the question, make sure you write a good English grammatically, and make sure it's a simple sentence generally. That's my take for you. Now, the order in which you answer the question, it depends on how excited you are. 15 minutes reading time. Just take your time to read through the questions very well. And then if it is the ethics, you can take it out. If it is the audit procedures, you can clear it out. If it is the public sector, you can clear it out. So there's not really an order here that I would really recommend. Just go with your ability. But please start with what you can do best first so you can build momentum. Okay, start with what you can do best first so you can build momentum. Because if you start with a question that you're not able to do because you thought you could do it, but then when you started reading the question, then pressure may start building up, and if care is not taken, you're going to end up having a lot of emotional hemorrhages in the exam hall, if I can say that, and that could affect you a lot. Okay, so that's my recommendation generally on what I expect you to do in the exam hall as you go in there, and it should be good. Okay, it should be good. We've done all that there is to be done. You know the things that are supposed to be there. Those of you who have been doing assignments and mock, you know the things you're supposed to do and the things that you're not supposed to do. So just go in there and make yourself proud. Management accounting students, your problem is just like these people, their problem. The same thing. Number one, read a question carefully. It's important. But number two is about the English language in the management accounting exam is different, especially when you're doing short-term decision, especially when you're doing budgeting, especially when you're doing variance analysis. Heck, if you're doing everything in management accounting, the English in the question is not the English your English teacher taught you. Management accounting has its own expression, its own understanding. Please make sure you take your time and read well. And like I say always, read as you work, okay? Read and work. Don't read the whole thing, you'll be overwhelmed, okay? So read as you work. And then know at what point have I read to and what can I do with that information. So take your time, read the questions carefully, but make sure you understand the management accounting context of the statements, of the expressions, of the notes, because in management accounting, something will mean different from layman's understanding. So you are doing something under whatever the heck budgeting, and the company says, oh, it is the policy of the company to keep closing inventory to cover 25% of the next month's sales. Okay, it's important you understand the implication of that if they are keeping 25% of next month's sales, then the first period that you are preparing for, 25% of that first period's sales will become the opening stock for that first period. You got to know that. And that is management accounting. So read the questions carefully, hold your breath, read as you work, and start with what you can do best first. My take for you in management accounting is this: because 30 to 40% of the question it's going to be written or comment area, take them out first. That's my recommendation to you when it comes to the management accounting. There is going to be a lot of theories. If the examiner is not happy with you, he will do 30%. And this will cover everywhere: the models of evaluation, benchmarking, total quality management, cost control, cost reduction, those things. Or under each of the topics, the theories there. Okay, so break-even analysis, the limitations, the assumptions, budgeting, the methods, the procedures, variance analysis. Why is this variance favorable? This variance is adverse. What are the types of this? So read the question. So in the 15 minutes reading time, what I want you to do is to read through the question and look at all the theories and find out which one you can answer best first, taking into consideration that you must answer each question on a fresh page. So if you can take out all the written parts as much as possible, then you can then come and start with the calculation issues. Okay, because you see, you don't want to finish the exam, you're on your way home or you are home, you pick the question paper only for you to see that, holy cow, question 4b is a theory. You read it before going to the exam hall, but you didn't do it. Now that broken heart will affect you, and you have failed the exam in advance, in advance, because you are like, gee, ade pa manye. So my recommendation is take away all the written part first. Then after that, question 1, performance evaluation. Check out what the heck is there and start with what you can do best first, depending on your understanding of the questions available. All right. So that's my recommendation to you. And that's where we draw the curtains on advanced audit and assurance and management accounting. So we wish you all the best, and go in there and do what you can, and let's see what you are supposed to do in that particular case. All right. Any other issue? Tomorrow we're gonna be meeting. I just want to see what we have tomorrow. Oh, what do I have? Screen. Tomorrow is taxation. All right. So tomorrow is going to be taxation, principles of taxation and advanced taxation. It's going to be lovely because I mean, these two guys they are almost the same, just a thin line in between them. So, uh, sorry, the tax is on Wednesday, but we'll meet tomorrow evening to talk about tax. Okay, for the Wednesday class. All right. So that's it about that. Let's see. I'm getting. Thank you. God bless you. God bless you too. So we wish you all the best. Good night. Make sure you get some sleep. Wake up tomorrow morning. Make sure you take good breakfast. Chill out and go and make yourself proud. Goodbye. See you tomorrow. Bye.